Hey guys, what's happening? Jay here. This is smarthelping.com. I've got another renewable energy financial model template here. It's for a prospective solar farm. It's for a single farm, and I will walk you through all the different assumptions and financial statements that get produced, and we'll go from there. Just a side note, I have been sick for a week straight, sore throat, so it's making things difficult, but really excited to get this out. So let's go through all the assumptions on each tab and you'll understand how it works. Strap in because this is going to be quite a long video. There's a lot of things to go over, and we got really deep into the weeds on how a solar farm actually makes money, what the costs are, and this is going to be a 20-year model as well. Okay, so we start here with the company name. This is just going to go on top of the financial statements. Forecast period, you could go any length up to 20 years. So you go, 120 months would be 10 years, 60 months is 5. Just pick the amount of months you want the forecast to display for. Then you can choose to include a terminal value or not, yes or no. And if yes, your exit value is going to be some multiple of the trailing 12-month EBITDA of the project. First month of forecast. Now this is flexible. You can put any date in here. It doesn't matter. The only relevant thing this is going to do is drive the seasonality because the model needs to know what month the first month actually is, because seasonality comes into play here, especially if your solar farm is in an area that doesn't get sun 24/7, 365 days a year. So you can put whatever date this lines up with the forecast, month one. Rest of this is just summary data from the other tabs, cash, debt, and you could enter some tax rates here. And then we have our check summary at the bottom to make sure all the financial statements all match. I put the executive summary up front. This is 20 years, shows you all the different things. It's just easier to access, and it's the highest level view that gives you a breakdown of revenues, expenses, cash flow, some charts, and some returns for the project, and investors and owners if you have a joint venture. I'll get more, you'll know this will mean more once we go through all the other assumptions. All right, so the first big tab is deployment costs. So this is where we're going to figure out how big is our farm going to be, what's the size, and when do operations start? And typically with these financial models, for the purpose of a model, it's going to be one single start month, and that's when everything goes into operation. So you can put that here, and then in the meantime, there's going to be, construction and implementation, infrastructure, all that. So you can see here, you can put in the size of the farm in megawatts, and then you can put in the capacity per panel on average in kilowatts, and that derives the total panels that you're going to be installing in the farm based on a simple math problem there. And then I also derived, based on the farm size down here, how many panels per acre you're going to have. We have the cost per panel, and that's just the raw cost. One sec, let me get a drink of water. So just the raw, you got to buy the panels from, a panel manufacturer. So that's the cost per panel. Then you've got mounting cost per panel. You've got the number of panels per inverter, the cost per inverter, and then total inverter costs. Electrical and wiring cost per kilowatt. So that's going to be driven off of the total kilowatts here. And you can see if I change this to say $200, that changes. And all these yellow cells you could change based on your specific scenario, and the math will work. We've also got the number of amount of land we need, so that's going to be derived on the total acres required per megawatt. So if we have 15 megawatts, 4 acres per megawatt, that's 60 acres, and then we just put in a cost per acre to derive the total land cost. Now, if you're leasing the land, you can zero this out, and there will be a leasing cost over on the OPEX tab at the bottom, which we'll go over later. Labor cost per kilowatt. So this is just the labor to get everything installed and up and running just at the startup. So you can put a number in there. I don't know if it would be $350 per kilowatt. It's just taking whatever number you put in here times the total kilowatts of the farm. So those are all the different main costs. They populate down here. You've also got permitting and compliance, which is a hard code number. And then I've put in 8 extra Capex slots here, as well as a contingency that drives off this percentage times the total other costs of the project. That gets us our total Capex spend for the farm, which you can see would vary. If it was a 20 megawatt farm, all these numbers go up. Now it's 25 million. If it's 10, so it's nice. It allows you to kind of set some parameters, and then you could change the size and see how your total costs change. Now, these costs might not be all happening at once. It could take 6 months, 8 months. Depends on a lot of things, how long it takes to actually build this. And in that sense, these costs aren't necessarily all going to be needed up front. If they are, you can just put all 100% in month 1 and then zero out the rest. But if not, you can put the average expected percentage of this total cost as paid in month 1 of the model, month 2, month 3, all the way over, up to 48 months. It's not likely that the construction period would last longer than that in any case. So you can spread those costs out. That'll affect cash flow. The actual amounts are going to populate down here. And there is going to be the option to use a construction loan, which we will get into. Loan 1's the construction loan. Loan 2 and 3 are just regular working capital loans. So we will get into those as well, which can offset the costs here. Okay, so now we know how big the farm is. We know when it starts. We know all these startup costs. So that's good. So now we need to know what kind of energy are these panels going to output. So we have our capacity curve. So we know, there's this many hours in the year. There's the nameplate capacity, which is just how many megawatts the farm actually is. Now that gives you your theoretical maximum output of megawatt hours in a given year. And then there's all kinds of different factors that play into your actual output. So you're not going to output 80. You can't run 24/7. You're not going to have 100% efficiency with all your equipment. So we go into a bunch of factors here. The first is effective solar hours. So this is saying of the 8,760 hours per year, how many hours are actually, going to have sun on the solar panels. So you can put that in here. I don't think you need to adjust it over a year, but you might. So I just have this adjustable. Every assumption can be changed over the course of the 20-year model. So as you go down, that's a new year. So effective solar hours, and that gives you your ideal solar output, 16,000 megawatt hours here. Now, there's other things. So panel and temp loss. If you didn't know, from my research, as these panels get hotter, they actually lose some of their efficiency. So you put in the percentage of loss from that. Now you got another subtotal. Now you're down from 16. You're down from your maximum of 87 down to 16. And after that, you're down to 14,000, which is, again, this number is what you can finally sell once we get all the way to the end, but that's what this number is showing. Inverter efficiency, new subtotal. Wiring loss, new subtotal. Soiling loss, degradation loss. And degradation means over time, you might get less efficient just from aging. In some systems, these panels can last for 20 to 30 years, 35 years, but it just over time they become a little bit less apt at converting sun to energy at some percentage. So you can put that here, whatever that is. And so 1% just means if 1% loss here, it's just saying, in year 20, we're getting 10% less than when we started in year 1. So that gives you another subtotal, and then you finally have some average downtime potentially, and then your final megawatt production. So this is what you're actually generating and can sell for through a couple different revenue streams, and your overall efficiency factor. Now some models might just be high level and allow you to input the efficiency factor as one number. I wanted to go in and actually go through each step, so this is more accurate. It can account for more factors to get to your actual efficiency factor. Okay, so now we know in a given year, over the 20-year period, how much expected megawatt hours we will produce. Now, we need to know seasonality. So this is pretty simple. Wherever the solar farm is being put, this won't change much, but you want to know of that total expected capacity in each year, what percentage is going to be produced in month one versus, which is January versus, April or May or December. So you can enter those percentages here, and this would be based on data that you have to gather for the area, but you can estimate of that total, which already this megawatt production already accounts for everything that could reduce it as far as um, all these different things and the amount of sun. So seasonality should add up to 100%, but you're just saying how much of that final amount is being output in each month of the year, and that pattern will apply through the whole entire model for 20 years. Okay, now revenue. So we know how much we can produce, but how much can we sell it for? So we have a power purchase agreement schedule. We have REC, which is renewable energy credits or certificates, as they might say. And we have options to sell to the grid directly. So all these have different factors. So the first is these three columns are power purchase agreement, and this means you have agreement with a third party to sell either all or some percentage of the power that you generate at a predetermined price per megawatt hour. And you could define what that price is. You could do yearly increments. Here we're saying we start at 160, but maybe we don't actually get up and running until year 2. So maybe we do 0% and then we start increasing from there. And whatever we produce, it'll be multiplied by this amount, megawatts per hour, against the total, what was it? The capacity production times this percentage for the given month of the year. So that's how all that math works for the power purchase agreement. Now, RECs are very interesting. This allows you, based on proven methods, to track how much renewable energy you create. You can actually sell, and there's a serial number derived, and usually it's 1 REC per 1 megawatt hour, I believe, created, and there's some price per REC, and people can buy those, and it's supposed to, in theory, you're incentivizing renewable energy companies to keep producing it. So that's not, that's completely, like, it's not taking away from how much you're selling here, it's on top of. So um, however much megawatt hours of renewable energy you produce, you can generate certificates and then sell them, and people can buy them, and they can claim they're helping with renewable energy efforts. So there's those. And then there's percentage power sold to the grid. Now, you can see this percentage here is saying if this is 90% sold through the power purchase agreement, then 10% we're leaving to the grid. And then that has more price fluctuation, so you can adjust the price in a given month of the year, and then have a percentage increase or percentage change of that over the 20 years. And the remaining 10% of the megawatt hours can be sold at these rates, whatever you enter here. And this is to the grid. And note that there's going to be different variable costs as well. When you sell to the grid, it costs a little bit more. With the power purchase agreement, you're only, you get paid a set amount and that's it. And then the company who's picking up your power has to pay all the other fees or deal with all that. So there's a lot of factors going on here. All right, so there's revenue. OpEx, we just have some fixed costs here. Now I did the first 16 can be a set start number, like let's say $1,000 a month, starting in month 15, and then increasing at 2% each year. Whatever you put in here, 5% or what have you, it'll adjust accordingly. And then the bottom 16 for the section can be manually changed each year. So maximum flexibility, and note these are annual amounts. So whatever fixed cost this is, you're going to be putting the expected annualized amount in the start month. It'll divide by 12 to get into the monthly detail, the cash flow. So there's 3 sections for the fixed costs. There's a section for percentage of cost as a total based on total revenues. And then the big one, the variable costs, which are going to be based on the size of the farm and the activity, are your direct costs, and we have direct fixed costs and direct variable costs. So direct fixed costs would be things that are directly related to producing energy, but they are not variable as far as how much energy is produced necessarily. So like land lease, insurance, service contracts, mowing, the grass, keeping all that, those are all fixed costs that are direct, which would mean it's a cost of goods sold or a cost of revenue or a cost of sales. So you can put the start month there and the annualized amount and then adjust it per year. And we've got 6 slots that are adjustable based on the percentages, and then these bottom 4 can be changed manually each year. Then we have variable costs down here. So this is a little bit more complicated. We have the potentially you might be getting charged maintenance costs for each megawatt hour generated. You could also be charged for grid fees with megawatt hours sold, as well as market participation fees. So these 2 here are only for sold things to the grid, which is this amount. These are for what's generated. And generated means total produced out of this total amount of production here. So it doesn't matter who you sell it to, the cost is related to how much is actually generated. So this is the cost per megawatt hour, and you can adjust these costs over time as well. And that'll just apply to either what's sold to the market, if it's these 2, or if it's these, it's going to be based on the amount generated over time. And REC tracking fees, again, that'll just be based on total generated. So those are how you're going to get your cost of sales. We have Capex, which this is just going to each of those Capex items we defined on the deployment cost tab. And all you're doing here is just adjusting the useful life to whatever makes sense for your situation. Notice how we don't have land. We have land here, and I just did a thing, but land would not be depreciable, so we'd put 0 on that one. But the rest of these, in theory, should be all depreciable because it's direct costs to get the equipment going and the farm up and running. And so those have a depreciation, and this will also be a direct fixed cost. It'll be a non-cash item because the actual cash that goes out is defined here in this schedule on the deployment cost tab based on the cost estimate and the total amount per month that's hit. So that's actually affects cash flow, but you want to see over time what are your margins. And this is, since these are directly related to being able to produce energy, that cost should go up into cost of sales and affect your gross profit margins. And it is a non-cash item, so we have to add it back when we get down to cash flow and EBITDA. But that is all accounted for there. So you can put in the useful life in years here, and you get a monthly depreciation. You got full-time employees, so there's 20 slot types. Start month count. Now, this is a bit overkill on the OPEX and on the full-time employees because this is a single farm model. It's not for, 5 or 10 or hundreds of farms that might have a little bit more overhead. Although, if you wanted to scale this, it would still, everything would have the same start month, but this could be multiple farms that are like a total of like maybe, I don't know, 1,000 megawatts or 500 megawatt farm in total. It's just you could adjust these costs happening over time and adjust when you're taking loans out on the construction loan, but the revenues would all still start on the same month number. Um, so depending, you might use more of these slots for the fixed costs and the full-time employees, but you might not. But anyway, you can pick the start month, the count, the annualized salary. You can also put in payroll tax and benefits if applicable in column Y, and that will just add to this amount on the monthly detail tab when we get over to the actual cost hitting the pro forma. Okay, loan one. So here you can define if you're going to take out any loans to pay for these deployment costs. So here we've got 6 million coming out month 1 and 6.4 million coming out month 4. So maybe I take out a $2 million in month 1, 2 million in month 4, and that can be more relevant if the construction period's longer and you don't want to pay the interest and get a loan right up front. You might draw on the loan, and that would affect your interest rate. So the model, you can start with a interest-only loan. It doesn't have to be, though. You could actually have the interest-only period just be 0, and that means month 1 is at the start of the P&I payments or amortization. But normally, if you're using a loan for construction, building a new solar farm, you're going to want to have an interest-only period. So we can define that here. Right now we put 12 months. It could be 6 months, 18 months, or what have you. You can adjust that IO period. And then the key is if you're going to switch to an amortization, in this case we are, you need to make sure the month of switch is always 1 month after the IO period. And keep in mind as well, now usually you'll be drawing on the first month, but if you don't, let's say our first draw is on the 4th month, that means, and if it's a 12-month period, I've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So technically my amortization month of switch should not happen until, in this case, month 16. And you can see there's errors over here in S because I need to adjust that. So this should be 16 in this case. Again, it should be the month after the IO period has ended. I put a note here, this should always be the model month number after the IO period ends. And then there, now you see there's no errors over here. It's all good. We have 12 months, and then amortization starts on month 16 in this case. And I had to do it like that to maintain maximum flexibility because you could have different months of draws and when this starts. So this is the only way to do it and have it work with everything else. Now on the switch month for amortization, you can put in the amortization period. It could be a term loan, meaning you could amortize over 20 or 30 years, but maybe it's only a 5-year loan or what have you. And then it'll pay back, you get a balloon payment if it's a term loan like that. You could always refi and configure loan 2 or 3 to kick in when that other loan ends at maybe a different interest rate. So there's a lot of flexibility with the different loans. You could have it run, let's say it's a 20-year term and 20-year amortization. Well, that's great, but we'll still pay back whatever is owed on the exit month if this is marked as yes for include terminal value. If this is no, then loan 1 won't automatically pay back on the exit, but you could still adjust an extra principal repaid. If you wanted to, you could do that. So like I could put, extra payments here. Well, that was too much actually, sorry. And the model will adjust accordingly, and you'll pay back the principal faster if you pay back some here because the payments stay the same. You can see here These are 15,506, 15,506. They're the same, but you have less owed because you paid extra, so you'll pay back quicker. If you want to account for that there. This all flows through to the financial statements accordingly. Loan 2 and 3 are simple. They're just a single amount that happens on a single draw point, and you could put the payments per year, usually that'll be 12, the interest rate, and the term of the loan. Cap table is pretty simple. This is where the model is going to look at all the different assumptions you just configured, and it will figure out how much minimum cash you need to keep your balance above zero based on all those different costs. And then so here it's saying we need 10.9 million. So we have two, I could put 0 here, and then it would just be all to the overflow. But if you have, maybe some outside investors and inside investors, maybe the insiders are going to contribute $1 million, and then the remaining goes to whatever hasn't been paid of this here or in these other boxes will then fill into the overflow. And also the percentage or share of profits you can adjust here. And the same goes for class A and B. If you have that, it'll all add together to one final percentage of profits. And you need to make sure the total of the top and the bottom is equal to 100% if you're going to use these sections. So here, maybe they're going to get 90% because they're coming with that much of the money, or maybe 95, and operators will get 5, or what have you. This can be all configured at whatever deal terms you come up with. It could be 50-50 or what have you. And then you have your cash flows over here and internal rate of returns for each individual row. And this is all pulling from our monthly detail, which we'll get into. Startup costs are just another spot to account for one-time initial costs at the beginning. Now these would be non-depreciable costs, maybe legal, just any other costs that you haven't accounted for that you want to happen all at once at the beginning. Terminal value, usually just set this to 100%, but you can determine if some of the costs will end up applying to the panels or not on the Capex side, not the farm itself. Here we've put 100%, so these all just assumed to have been, we're not really marking our revenue or sales proceeds against these for tax purposes. We're just saying it's all extraordinary income. If we put 100% here, and that'll be just be taxed at your effective tax rate, whatever you put here. But there's flexibility if you want to do, say, half and half, and you still got some depreciable life left on your Capex items, and want to assign some of the sales proceeds to that, you can. Okay, now financial statements. We have income statement. So based on all the different assumptions, we can see we've got our revenue over time for the 4 different types of revenue. And the first 3 we went over. The last one's a hard-coded input that's on the monthly detail. We've got your fixed and variable direct costs over time. And remember, your depreciation's coming in here too. Gross profit, other operating expenses, EBITDA, interest, depreciation, taxable income, and this is not being double counted, remember. So EBITDA, we are adding back that depreciation item, but we want to see that depreciation item here so we can know the gross profit when that's accounted for. We add it back in EBITDA, but then we take it out when we're figuring out taxable income, because obviously depreciation is tax deductible. And then we have our exit value happening here, and that's going to be a little bit more tax hit. Income statement annual, same deal, but on an annual basis. You can see everything all in one view here. Balance sheet, we've got cash, our fixed assets, accumulated depreciation, total assets, liabilities, all that different debt. You see in the interest only period, it's not going down. Then when we start on amortization 116, it starts going down. That's all dynamic. Money raised from investors, owners, it's equity, retained earnings, total owner's equity, and remember the accounting equation, liabilities plus owner's equity equals assets. So that all matches. And this balances through the whole period, all the periods, as you adjust assumptions. And balance sheet annual, same deal, but on an annual basis. Cash flow statement, kind of like your uses and sources. This is showing, here's the annual version, all the revenue collected, expenses, tax payments, depreciation add back. Because remember, we're taking out of this operating cost here, so we got to add it back because it's not a cash item. It actually hits cash here in the Capex row. Then we've got loan proceeds, principal payments on the debt, raising money, net change in cash, which will go over to the balance sheet monthly cash position. And remember, this model solves for zero cash position, so it's going to look at all your assumptions and say you need to raise this amount to keep cash exactly at zero or higher over the life of the model. Okay, now we have discounted cash flow analysis. So we've got, again, the project itself. Here's your internal rate of return. You can plug in a discounted cash discount rate for discounted cash flow analysis and get the net present value and present value of future cash flows. You can also do the same for investors and owners based on their percentages, and they all have their own IRRs and discount rates for their own discounted cash flow analysis. Got a chart here for them. Now this is going to assume whatever your minimum equity requirement is will come up front for the purpose of modeling, and then any cash distributions available will hit here to figure out your IRRs. Now I know if you have different investor terms and agreements, there's a million different ways to set these up. I usually end up modifying them for specific cases if you do want to see a more granular view of investor contributions and distributions and tie that into the monthly cash flow of the project. I've done that on all kinds of scenarios as well. And remember, you can hire me to do custom work. I'll show you how to do that at the end of the video. The visuals, we got revenue, gross profit, cash flow, EBITDA, and this is adding back depreciation, remember. Gross profit margin, EBITDA margin, annual revenue by type of power, annual maximum versus expected generated output. So this here, these two are essentially the difference between our capacity theoretical maximum versus what we actually end up getting over time. And then we have overall efficiency factor, which is going to be the variance of these two, and there's that percentage. Now, how all this happens is we have the monthly detail. This is kind of the driver of the model over 20 years, or however long you run the forecast for. It's got your maximum output, your expected output, capacity attained, or capacity factor, and then here's your power purchase agreement revenue, the grid revenue, renewable energy credit revenue, and then other income you might have, ancillary or other government subsidies, which is just manual input, total revenue, all your direct costs, gross profit, other OPEX, staffing, all these detailed looks, your loans, principal interest, startup costs, Capex, taxes, exit proceeds, and final cash position, which is used to drive most of the rest of the model. Your annual details the same thing, but just on an annual view all the way down. And if you want to see just a higher level, you can click the little boxes up here and it'll minimize so we can see almost the entire pro forma in one view, all the way down to cash flow. All right, so that's my underwriting model for solar farm startup for a single solar farm. I think it is super granular, very customizable, and if you're looking at starting a solar farm, and you want to really get down into the weeds of how much it's going to cost based on all these different things and how much energy you're going to produce, seasonality, different revenue streams. This is a full boat model that can allow you to go through the simulation and um, figure out what's feasible, different pricing assumptions, different cost assumptions, and just run a bunch of different scenarios to see what works. Now, to download this, obviously, because you want to use it, all the models I build are fully editable and unlocks all the formulas, so you can go in and change whatever you need or use it however you want. If you want to download it, you can hop on over to smarthelping.com, and it will be, this one's going to be in the two spots. If you go to the home page, it'll be in the industry models, and it will be under, I believe I'll put it in the industrial section at the top. Also, though, I do have a specific renewable energy bundle. Go to the niche bundle templates here, renewable energy. So I've done hydrogen plant, hydropower, wind farm, biogas, EV charging stations, and solar panel installer, which this is different. So I'm happy to add, I'll be adding the solar farm to this, and I might end up adjusting this price here. I don't know. Maybe not. Maybe I'll leave it at 125. So essentially, if you want to buy more than one of these, you might as well just buy the bundle because each of these are costing between $65 and $75 anyway. Uh, I think one of them's 45. But yeah, you might as well just buy the bundle if you want more than one of these. Um, so I'll add that here. And feel free to explore the site. You can hire me, higher pay, $275 an hour. Usually I got quick turnaround times, 1 to 2 days, and it's just pay as you go. You can read through the terms. Also look at my expected. I keep stats now of all my work, hours spent on on average per job, and per year per client. On average for active clients, you can look at the stats and see roughly, what you might expect just based on all the clients I've worked with over the past, well, this is since data is since 2000 and oh, I do a running 5. I just changed all this, so this is just the most recent 5 years worth of data. Except there is lifetime data in here, lifetime hours and lifetime spend by yearly cohort. So this is, well, I guess it's a cohort, so it's saying anybody in like that joined in 2020, here's how much they spent for the entire time that they've ever been a client. Here's how many total hours on average per client. Retention cohorts. So check that out. You can read the video about it. You can also get, if you go to the Financial Models tab at the top, Super Smart Bundle, $4.99. That includes, you can buy every template I've ever built, which there are, if you look here, quite a bit for different industries. So just a massive knowledge base of things that I've put a lot of time and effort into, and this is just a great resource to have for anybody in finance or just generally around businesses or run a lot of businesses or analyze a lot of businesses. This is a super good resource. Alrighty, well, that's all I got for you today. Like and subscribe, and I'll see you on the next one.